Most investors know two moves: buy and sell. That's it. But markets offer a far wider playbook, strategies built not just around whether a stock goes up or down, but around time, volatility, pricing gaps, and corporate events. Strategies that have, until recently, been available only to a small set of sophisticated institutional participants. With the introduction of specialized investment funds, that changes. What follows is a series of concepts, each one a building block of what structured investing can look like. Each one explained simply. These are not guarantees of returns, they are strategies, each carrying its own risk profile, its own conditions, and its own trade-offs. Understand them because knowing the playbook is often the first step. Most investors own stocks and just wait. There's a strategy that may generate income from those same stocks without selling a single unit. It's called a covered call. You own the stock, you sell someone the right to buy it from you at a higher price for a fixed period. They pay you a premium for that right upfront. Hypothetically, you own one share at Rs 500. You don't expect it to cross Rs 550 this month. So you sell a call option at 550 expiring in 30 days. Premium received Rs 20. Three scenarios at expiry. Share stays at Rs 500, the buyer doesn't exercise. The Rs 20 premium is yours to keep. Share rises to 530, still below 550. Option lapses. Premium retained plus stock appreciation. Share jumps to Rs 600, buyer exercises. You sell at 550. You miss the upside above 550. That's the trade-off. And if the stock falls sharply, the premium received may reduce the loss. It does not eliminate it. You're not selling the stock, you're offering the upside above a price you didn't expect to reach anyway. And you're getting paid for it. This is a covered call. The idea is straightforward, but running it well, selecting the right strikes, timing, rolling positions, that requires active monitoring and execution discipline. That's the kind of structured options strategy a specialized investment fund is designed to manage. In a market crash, panic selling at the bottom locks in permanent loss. But staying invested without any protection can be equally costly. There's a third approach. It's called a protective put. You buy the right to sell your stock at a specific price within a fixed period, like insurance on your holding. You pay a premium for that protection. Hypothetically, you hold one share at Rs 500. Big event coming up, you're bullish long term, but you want to limit downside. You buy a put option at Rs 450, expiring in 45 days. Premium paid Rs 20. Three scenarios here. Stock falls to 300 without the put. The loss on this example is 200. With the put, you may exercise at 450. The loss in this scenario is limited to Rs 50 on the stock plus Rs 20 premium paid. Rs 70 in total. Stock rises to 650. The put lapses. Stock appreciation in this example is Rs 150. Premium paid Rs 20. Stock barely moves, the put lapses. You paid Rs 20 for protection that wasn't needed this time. A quick note, actual outcomes depend on option pricing, timing of exercise and market conditions at that time. It's not just about limiting loss, it's about staying calm enough to hold because your downside scenario is already defined. This is a protective put. The concept is simple. Insurance for your portfolio. Running it across a fund means constantly monitoring positions, rolling protection, and timing entries correctly. If you have shorted a stock, you are exposed to unlimited upside risk if it moves against you. There's a way to put a defined calling on that exposure. It's called a protective call. You have shorted a stock, expecting it to fall. You also buy a call option at a higher price. If the stock rallies unexpectedly, the call may limit how much you lose on the short. Hypothetically, you have shorted company A at Rs 500. You buy a call option at 550. Premium paid 20. Three scenarios here. Stock rallies to rupees 700 without the call. The loss on this short is, in this example, rupees 200. With the call, you may exercise at rupees 550, limiting the loss on the position to rupees 50 on the stock plus rupees 20 premium, rupees 70 in this scenario. Stock falls to rupees 350. The short position moves in your favor. Illustrative gain rupees 150 less rupees 20 premium paid. Stock goes sideways, call lapses. You paid rupees 20 for protection that wasn't needed this time. Actual outcomes depend on option pricing, execution and market conditions. You still hold the view that the stock falls. You're just defining how much you're willing to lose if you're wrong. This is a protective call. Straightforward concept, but layering options protection on top of an active short position requires real execution discipline and constant monitoring. That's the kind of structured approach specialized investment funds apply across every position. The same share, two different prices, same movement. That gap, when it exists, is what arbitrage strategies attempt to capture. Arbitrage involves simultaneously buying an asset where it is cheaper and selling it where it is priced higher. This aims to potentially capture the price difference. No directional view on the market is needed here. The two positions offset each other. Hypothetically, company A trades at rupees 500 in the cash market and rupees 512 in the futures market at the same time. An arbitrage strategy would involve buying at rupees 500 in cash and simultaneously selling at 512 in the futures. The two legs offset each other. There is no net directional exposure to the stock. At expiry, cash and futures prices tend to converge. If they do, the illustrative difference of rupees 12 may be captured. However, that gap typically lasts only seconds. It requires simultaneous execution on both legs. An execution risk. The failure of one leg to fill is real. This is not a risk-free strategy. No view on whether the market goes up or down. The two positions offset. The potential return here comes from a pricing gap and not market direction. This is arbitrage. Simple in concept, the execution is what makes it complex. Specialized investment funds can run this systematically with the infrastructure and risk management required. A return stream that doesn't depend on market direction. That's what makes it different. What if your options position didn't need a market direction call at all? Just a view on whether the market will move significantly or stay quiet. That's a straddle. You take a position in two options on the same index, a call and a put. Same strike, same expiry. The direction doesn't matter. What matters is whether the market moves sharply or stays range bound. Two approaches. You can go long or short. Opposite views, opposite risk profiles. Long straddle. You're taking the view that the market will move significantly. Hypothetically, index at 22,000, you buy a call at 22,000 and a put at 22,000. Total premium paid 400. Index moves to 2,500 in this example. The call may be worth rupees 500 after the rupees 400 premium paid. Illustrative gain rupees 100. Index moves to 21,500. The put may be worth rupees 500. Same illustrative outcome. Index stays near 20,000. Both options may lapse. Premium paid of rupees 400 is the loss in this scenario. You need the index to move more than the total premium paid in either direction to be in a favorable position. Short straddle, the opposite view. You expect the market to stay relatively quiet. You sell both options. Premium received rupees 400 upfront. Index barely moves. Both options may lapse. Full premium received is retained in this scenario. Index moves rupees 400. Illustrative break-even. Premium received covers the loss. Index moves rupees 600 or more. Losses on the position may increase significantly. There is no defined ceiling on potential losses. Both sides of the position are exposed simultaneously. Short straddle rewards a quiet market but carries substantial risk if volatility spikes unexpectedly. Same two options. Buy them, you're positioned for a large move. Sell them, you're positioned for calm. Two completely different risk profiles from the same structure. This is a straddle. The concept is accessible, but managing both legs actively, reading volatility correctly, and handling a short straddle when the market moves sharply requires real expertise and infrastructure. A straddle and a strangle are built on the same idea but with one key difference in construction. That difference changes the cost, the break-even and the risk profile entirely. In a straddle, both options are bought at the same strike, at the money. In a strangle, you buy the call at a higher strike and the put at a lower strike, both out of the money. Lower premium but a wider move needed to reach break-even. Again, two approaches, long and short. Hypothetically, index at 22,000, you buy a call at 22,300 and a put at 21,700. Total premium paid Rs 160. Index moves to Rs 22,700. In this example, the call may be worth Rs 400. After 160 premium paid, illustrative gain Rs 240. Index moves to 21,300. The put may be worth Rs 400. Same illustrative outcome, index stays between Rs 21,700 and 22,300. Both options may lapse. The Rs 160 premium paid is the loss in this scenario. Lower cost than a straddle, but you need a larger move to reach break-even. Short strangle. You sell both out of the money options. Premium received Rs 160. Index stays between 21,700 and 22,300. Both options may lapse. Full premium received is retained in this scenario. The safety range is wider than a short straddle. Index moves to 22,460 or 21,540. Illustrative break-even in this scenario. Index moves sharply beyond those levels. Losses on the position may escalate. There is no defined ceiling on potential losses. Short strangle offers a wider range of favorable outcomes than a short straddle. But once breached, the losses can be severe. A straddle asks, will the market move? A strangle asks, will it move enough? Lower cost, wider range, higher threshold and same family. Just that both have different trade-offs. Straddle and strangle, the concepts are accessible, but managing the short side of either, especially when volatility spikes unexpectedly, requires active risk management, real execution infrastructure, and clear position level discipline. That's precisely why these strategies are structured within specialized investment funds and not standard mutual funds. A company announces a demerger. The stock drops. Most investors exit. A different category of investors starts doing their homework. Special situation investing focuses on stocks where a corporate event, not business weakness, has created a pricing dislocation. The thesis isn't a market direction call, it is an event call. A few examples of events that may create these situations. Merger arbitrage. Company A is announced to be acquired at Rs 550. It trades at Rs 500 post-announcement. That Rs 50 gap represents a potential return if the deal closes as announced. If it doesn't, the stock may fall back towards pre-announcement levels. Deal risk is real. Spin-off, a parent lists a subsidy. Certain institutional investors may be required to sell it due to mandate restrictions. That selling pressure may create a temporary discount which may close over time. Distressed situations. A company facing financial stress may trade at a price that doesn't fully reflect its underlying asset or recovery value. The analysis is complex and the outcomes are uncertain. In each case, the edge, if any, comes from a rigorous event analysis, not a market view. The situation looks complicated. Most investors avoid it. That avoidance and the forced selling it creates is where the potential pricing gap may exist. Special situations require concentrated positions, patient capital, and deep event level research. A standard mutual fund's regulatory framework limits its ability to pursue these strategies. Specialized investment funds are structured specifically for this, strategies that don't depend on market direction.
An investor education and awareness initiative by Bandhan Mutual Fund.
Investments in specialized investment funds involve relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all investment strategy related documents carefully before making the investment decision.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.